Okay,
Okay.
so I'll record it, and it's pretty good. It's a commercial account, so it should be done about an hour or so. I got a session right after you, as I said, 15 minutes later. So when I'm done with that, I'll send it to you for sure. Okay, so we're going to start with parity, and I think you were on the right track. So parity means equal, right? So I say Diego, Maradona is parity with some other famous soccer player. That just means they're equals, you know. I say nobody has parity with Pele. That means nobody's better than him. They're not even to him. So that's the key word. As I told you, I'm sympathetic that English is a second language, but that's what parity means. It means equal. So what is parity? I like what you said. You said, Dean, I'm trying to get everything to 80. And then I joked and said that's above parity or above par, because equal would be 72 for your passing rate. So it sounds like you're pretty good that you always are going to need the conversion ratio. So you cannot do any calculation without the conversion ratio. And it depends on your draw. It sounds like you didn't get a great draw last time. But sometimes they'll tell you what the conversion ratio is. They'll just point blank say it's convertible into. But where Kaplan has told you to be aware of, and it is important, is that when you're given the conversion price, you can't do anything with that. So the minute they say conversion price, I got in trouble with an HR department at a brokerage firm because I said, and they called me and said, "Did you say this?" I said, "I did." And I said, "Listen, when you get the conversion price, you kind of got to say bastards. Instead of giving me the conversion ratio, they're giving me the conversion price." And so maybe we're saying a convertible bond is priced at 130. And again, it's like learning a foreign language, right? When you dream the foreign language, you know it, right? So I guess when you dream your first Series 7 dream, now that's 130% of par. And so you say, okay, so they're telling me this bond is priced at 1,300. And they say this bond has a conversion price of 40. What we're first going to be interested in parity is to say, if we buy this convertible bond for $1,300, what if we converted it would we be paying for the stock? So it's equal to what in terms of the stock? Because if we don't think that's a good value on the stock, then we shouldn't buy this convertible bond. And so the first thing we're going to do is, as it says in Kaplan, your step one sounds like you're good. We're going to take par, because the conversion terms are always based on when the bond was issued. And I was just tutoring somebody the other day. They were watching my lectures, and I'm easily impressed with myself. But she said, "Dean, you say in one of your lectures you can't decide what to do, divide." And I forget what I say, but I go, "Yes, that's true." Almost every time we're trying to do some math, it's going to be division of some sort. And once I do that, now I'm back in business, because now we know that we can turn this bond in and get 25 shares of the common stock. So now we're back in business. Now, as we said, we're almost always going to divide. And so I'll put my little divide bar there. And what we're going to do is we're going to take the current market price of the convertible. The current market price of the convertible. So that's why you got to know this bond speak, right? So the current market price of the convertible. CMP means current market price. And the current market price of our convertible we're looking at is $1,300. And so we're simply going to take that $1,300 and we're going to divide by the conversion ratio. The number of shares we can get by turning in the bond. And so that's the conversion ratio. Another way we can think of that is the number of shares. Whatever we want to think of number of shares, we can think of that as the conversion ratio. Whatever we want to think of that as. In our example, we have solved for that. And we now know that we can turn this in and get 25 shares of the common. And so the test question would be, and it is testable, you might have to do this more than once. As you know, you've been in the cave to slay the dragon. You'll get it next time. I mean, you saw the dragon. 68 means you kind of got a good look at him. Yeah, he still got you, but you're going to get him next time. And so I say, Diego, if we buy this convertible bond for $1,300 and we turn it into the common stock, we would be paying 52 for the stock. Now, the question is, you say, well, Dean, what is the stock at right now? If the stock's at 54, whoo, we found an arbitrage opportunity, right? If we can get it at 52 and it's trading at 54, we'll buy this all day long. Arbitrage test question is profiting from price discrepancies. Profiting from price discrepancy. Typically, the stock would be trading at something less than that. The stock would be trading at somewhere below parity, right? Now, when this thing was issued, so that's the current market price of the convertible. So it doesn't mean we're not going to buy this bond. It just means if we do buy this bond, our minimum expectation is the stock is going to go from 50 to 52. Otherwise, we should take a pass. If we don't believe that, then, we should, say, well, I don't think that's going to happen. So I said, well, if we don't think that's going to happen, then we shouldn't, do this, because paying $1,300 for this bond is the equivalent of paying 52 for the stock. Right now, the stock is 50. So we're hoping the stock goes, somewhere above that. But in the meantime, we at least still get some, interest income for, 6% or whatever the bond is paying. All right. So that's parity. And that's how we do parity for the stock. I think it's more likely you're going to see parity of the stock than you are parity of the bond. So remember, that's what this means. So anytime we parity, what we're being asked is equal. That's what it means. I say, hey, what is, par? Everybody's par is different, right? So,
Right.
not a math, by the way. The good news about the math, even if me, I find math incredibly boring, but the great thing about math, that's why math geeks love it, is, it's always going to work. I find it kind of boring, but here, if we have this now, so let's just put that there. So parity means equal. Now, the other thing we might be interested in is going the other way. We might be interested in what is the bond worth that we're considering purchasing. Right. So we're either starting, with this idea, we're going to start with the bond and look at the stock, or we're going to start with the stock and look at the bond. Right. So then now we're saying, okay, well, if we're considering purchasing this bond right now, what is this bond worth in terms of being equal with the stock? And so now we say, okay, well, if we can get 25 shares of the stock, and that is a $50 stock, I say, Diego, if we buy this bond, right now the bond's only worth $1,250. We buy it at $1,300. We're going to have to pay a $50 premium because, right now, and that would be typical, right? That this bond is going to be trading at a little bit of a premium to parity. Right now, this bond is worth, in terms of the stock, it's worth $1,250. The bond at $1,250 is equal to 25 shares of the stock at 50. That's what that means. I think this is the one that shows up more often on the test, but you could get, two parity calculations. And, as I said, we kind of want to embrace, and same thing with margin and options. We kind of do want to embrace it because, again, it's math. And if we can do the math, we get the question right. Now, I would agree it's a challenge to pick this out of the lineup, so to speak, in terms of the extra BS that's in the question. So let me phrase this as in test phraseology. Let's do parity of the stock in test phraseology. A convertible bond is priced at 130. It has a conversion price of 40. What is parity? And you got to do this to come up with the 52. Or the other version. The common stock is trading at $50. The convertible has a conversion price of 40. What is parity of the bond? Now, I'm about to give you, Diego, the most hellacious question you could expect on this. And so, by the way, I'm telling you, I'm giving you the same exact question. Intellectually, I'm about to give you the same question. I'm just going to camouflage it with a lot of other BS. A convertible bond is trading at a 30% premium to par. A 30% premium to par. So I say, okay, By the way, I wish the test was weighted, because if it was, I'd give you like 5 points if you get this right. Now, the good news about you being at 80 is that you can assign things to the universe. You can guess B and say, I'm going to make up that elsewhere. We are trying to find you the points to get you over the top. So I'm going to take my calculator, 1,000. It says a 30% premium to par. So now I get 300. So now I know that that part of the question means it's priced at 130, $1,300. It has a conversion price of 40. So now I say, okay, I need to figure out that's 25 shares. It says if the common stock is trading 2 points below parity, if the common stock is trading 2 points below parity, what is the common stock trading at? And then you got to say, okay, well, I got to do parity. Parity is 52. So 2 points below that would be 50. That's basically the same question, just camouflaged with a bunch of junk in it, right? So your client's considering buying a bond, a convertible bond at a 30% premium to par. It has a conversion price of 40. If the common stock is trading 2 points below parity, what is the common stock trading at? P.S. In terms of this thing where it says it's trading at 2 points below parity, points in stock are $1, you should definitely know that. And points in bonds are $10, and you should definitely know that as well. Okay, so your next thing we want to do is suitability on a muni bond. So the first thing we need here is, what is your tax bracket? What is your tax bracket? So the minute on the test you see a tax bracket, you say, oh, I bet they're going down that road about whether the guy should buy a muni. Almost, most of the time, you can almost get some of it right by just knowing rich people buy munis and poor people do not. Right? So the minute they say he's in a high tax bracket. So they say your customer is in a 35% tax bracket. And what we're trying to decide is whether we should buy a taxable bond or whether we should buy a tax-free bond. And again, a lot of it is language again. Right. So what I mean by taxable bond is we mean a corporate bond. And tax-free bond means we need a municipal bond. And so as your broker, I say, hey, I'm trying to decide, Diego, what kind of bond I should put into your portfolio. Should I put a taxable bond into your portfolio, or should I put a tax-free bond in your portfolio? And so again, remember, equals is really important. So now what we want to figure out is, if I buy you a taxable bond, after you pay taxes, what would you be left with? Because you don't really care so much about what you're making from the investment. What you care is what you get to take home. What is your take home pay? And so what I want to know is, what is the tax-free equivalent yield? So getting X taxable is worth, what tax-free. So basically what I'm going to do is I'm going to take out the taxes. I'm going to say, okay, this is a taxable bond, so you're not going to take home all this money. And then we got to decide, okay, well, that's what you're left with after you pay taxes. Now, if we don't pay taxes, if we buy a muni bond, we're not going to be paying taxes. And that's an important consideration because, it's tax-free. And so the other thing I might want to be able to figure out here is, after not paying taxes, what would be the taxable equivalent yield? Basically, I'm trying to figure out is whether you should buy a muni or corporate. So that's where we're heading. So again, we're going to need on the question, we should be looking for, because this is the hint about which direction we're going to go. So on the test, they're either going to give you a taxable yield or a tax-free. So they're going to deal with one or the other. And let's say they give you the taxable yield, and they say your client is considering buying an 8% taxable bond. An 8% taxable bond. Well, that means corporate bond. That's what that means to say that, right? And then, you can go about this two ways. One way you can go about this is I can say, Diego, an 8% bond is going to pay you $80 in annual interest. That's 8% times 1,000. But Diego, you just told me that you got to give 35 cents of every dollar you make to the United States government. Diego, taxes are the price you pay for civilization. And the more civilization you want, the more taxes you got to pay. Right. My brother likes living off the grid, and I tease him. I said, well, he's always bragging about how much taxes he doesn't have to pay. And I go, yeah, but Chris, there's no infrastructure whatsoever. I keep saying that mom is retired. I take care of mom. He goes, well, you can leave mom with me. I go, Chris, there's not a hospital for like 2 hours away. I mean, I'm in Las Vegas, and if, mom has a problem, like the other day, she fell, I called the fire department. They were here in like, 5 minutes with 2 fire engines. And yeah, I got to pay for that stuff. But, all right. So one way we can do it is to take the percentage, or we can take the dollars. Either way we can go here. And if we're going to take the percentage, so I say, Diego, getting 8% taxable, getting 8% taxable in your bracket. So you remember, that's what we're trying to do, is figure out what this 8% looks like in terms of giving back some of that money. Now, in terms of math, we always do the things in parentheses first. And so you could think of this again as either a dollar, one, or you could think this as 100 cents, which is the same thing as a dollar. And then we say, well, you're not getting to keep all of that, because remember, you told me you're in a 35% tax bracket. And as we said, what we're interested in is your tax-free, what you're taking home on this thing, right? And you're not taking home the 8%. You're taking home 0.65 or 65% of that. And again, we do the parentheses first. By the way, as a test taker, the minute I got, just as a test taking tip, the minute I got that bracket, I would just do that immediately, because no matter which way we're going, we're going to have to do that. So I might as well just take my scratch paper and immediately just figure out that right away. There's no scenario in which I'm not going to have to do that. Okay, so now I get my calculator and I say, Diego, in your tax bracket, getting 8% taxable is the same as getting 5.2 tax-free. And the point, Diego, is there are no muni bonds right now that pay 5.2 or better. I mean, 5.2 is the same as getting 8, and better than a muni that pays you 6 would be the better way to go. So Diego, if we right now can't find you a muni that pays 5.2, all the munis are paying 3 or 4. And so even in your tax bracket, you should buy the 8% bonds and pay your taxes and still be left with 5.2, because 5.2 is better than what munis are paying right now. So that's why we're doing the math, is to decide whether you should be buying taxable bonds or tax-free bonds. And hey, Diego, interest rates change. So who knows, maybe some future date, we do the math again, and maybe munis, corporates are paying 4 and munis are paying 5, who knows? But right now, as your, investment professional, it looks like we should stick to the corporate taxable bonds, because they pay, after you pay taxes, the 8% is 5.2, and munis don't pay that. And by the way, that's the whole point of why we're doing this, is so we can compare not apples to oranges, apples to apples, right? So we can make this comparison to decide what's doing. All right, so that's the first one. Now, the other way we could do this is on the test, is instead of giving you the taxable yield, we could use a muni. And now we're going the other way, right? So again, when you're doing the question, the first thing you want to look at is say, okay, are they asking me about a tax-free bond or a taxable bond? And that'll be in the setup of the question. So now let's say we're considering a 3% muni, a 3% tax-free. Now it's your job again to know that what that is a muni bond, right? So they don't have to say 3% tax-free. They could say 3% muni. And I say, hey, Diego, I'm thinking about putting a municipal bond in your portfolio. And you say, geez, Dean, 3%. I go, whoa, Diego. It's 3%. Yeah, I know that sounds low, but remember, that's 3% that you're not paying taxes on. And so 3% and not paying taxes is more attractive than you would think. I mean, you would think that 3 is not attractive, but we don't know how attractive it is. So what we need to figure out, Diego, in your tax bracket, what getting 3 and not paying taxes is worth in terms of comparing it to taxable. So we can decide whether this muni makes any kind of sense. And so the way we're going to do that again is we're going to take the 3%, and that 3% are $30. And again, we're going to divide. So almost the entire series 7 is either division or multiplication, and more often it's division, right? So let me get a bigger font there. And so we're going to divide by 100% minus the tax bracket. And as I said, that's when you got to do no matter what version of this they're asking you about. So no matter what, version of this they're asking, this is what you're going to have to do. Right. So as I said, we're going to do that, first. Let me just label that. So come on. Let's put it in a different color. Boom. Right. And so now we got 0.65. And, on the test, they say, what is the taxable equivalent? And the taxable equivalent here, boom. Let's do our math. Get out my calculator. And I'm going to take 3%. I'm going to divide by 0.65. I say, Diego, in your tax bracket, getting 3 and not paying taxes is the equivalent of getting 4.6 taxable. And so that's how we should make the decision. We should be making this decision on getting 3. We should make the decision on getting 4.6. Is that attractive? And you go, why 4.6? Because I said, well, Diego, because, we're not paying taxes. So getting 3 is the equivalent of getting 4.6. So if we think that's attractive, then we should buy this muni bond. If we can get more than that in a taxable bond, we should buy the taxable bond. If a taxable bond pays less than that, we should buy this. So that's the point of doing the math, right? So key takeaway on this is we're going to give you either one, right? Not both, either one. And you just got to figure it out. By the way, another test taking trick. Sometimes, Diego, you can shop the answer set. If it's a taxable yield, the answer is going to be something less than that 8%. And sometimes you can just shop. I give you a taxable yield of 8. And okay, well, I got to pay taxes. So it's got to be something less than 8. That gives you a 50-50. And if they give you a muni, it's got to be something more, right? So you could say, okay, it's a 3% muni, so it's got to be something better than 3. When I do the math, and that 2 will give you a 50-50. So, sometimes, before I'm kind of lazy on the math. So what I mean by that is I like to look at the answer and see, am I going to have a shortcut? Maybe I have a shortcut, maybe I don't. But if I do, I say, oh, hey, and look at that. I don't have to do as much work as I thought I was going to have to do to solve this. Okay, so our next thing on our punch list was straddles. Straddles have 4 test questions. By the way, this will help you out on your other ones as well, because if you can't identify a strategy, you're already in kind of hot water. If you can't, for example, you said hedging. So as a test taker, you say, oh, this is a stock position. So this guy has stock. That's what dominates. It's a covered call or protected put, or this is long and short, the same type of contract. This is a spread. So even if we can't, do that, that should be our first kind of a thing to do, is identify it as either what kind of strategy is it? I think a lot of test takers get hung up. They're thinking there's a zillion types of strategies, and there's not. There's only, not 9 option strategies you're held accountable for. And so, I say, I'm not sure what's going to happen, Diego, with Apple. I think that Apple is either going to go up or down, but I'm not sure whether it's going to go up or down. And, if I just thought it was going up, I would buy a call. But I'm not sure whether it's going up or down. And so I'm just going to buy both. I'm going to buy a call and a put. I'm straddling the strike price line. That's why it's called a straddle, because I'm straddling the strike price line. And so that is our first test question about a straddle. Can you tell me what you're looking at as a straddle? Now, it's called a straddle. As I mentioned, here is the market price of Apple. Here is the market price of Apple. And how far up can Apple go? To infinity and beyond, right? And here's our strike price. That's why it's called a straddle. And what we're straddling in this example I'm showing you is 165. That's what we're straddling. If I really wanted to teach you options, I'd make you buy one. And once you were out of pocket, you'd figure out pretty quickly, how this works. Now, the second thing we got to be able to do is we have to be able to calculate the break evens. This is the only option strategy. The only option strategy in which you have more than one break even. We're going to have our upside break even, and we're going to have our downside break even. Way north of the test, but you're either buying volatility or you're selling volatility. Volatility in the stock is either your friend or your enemy. And so what we're going to have to do here is we're going to have to calculate our upside break even, let's put that in a different color, and our downside break even. We have a great mnemonic device, a great memory aid device, and it's called call up and put down. Call up and put down. So, we either going to be netting premiums, spreads, or we're going to be combining premiums, straddles. Right. So in a spread, remember, you're going to be dollars out and dollars in. And a straddle is going to be dollars out, or dollars in, because we have long straddles and we have short straddles. So to get our upside break even, we're going to take the strike price, XP means strike price, plus total premiums. Strike price plus total premiums. Because, that's how much you got to cover out of pocket, right? That's how much movement you're going to need to make this work. And so, as we said, what we're straddling here is the strike price. And so we're going to take our strike price of 165. We're going to add the combined premiums. What are the combined premiums here? Right, the combined premiums are 13. Right, so that's going to be our combined premiums. And I'm going to do that, boom. And I get 178. So let's put that here. And that is called our upside break even. So we have two. We have an upside break even and we have a downside break even. All right, so let's do our downside break even. By the way, stay menu driven, Diego, but once you get done, you can think about it, but don't think about it till you get the menu done. What I mean by that is, you can kind of, if you understand contract specifications and you say, okay, I have a choice to buy Apple at 165. So if I buy Apple at 165 and Apple's 178, I'd make 13, I spend 13, indeed I break even. So, don't do that though till you get the menu done, right? So you can actually kind of almost prove to yourself the break evens, if you will. Now, I don't know where you're at in your options expertise, You know, as we said, we're trying to get everything above par. But another thing that kind of works pretty well is a T. You know, what I mean by the T is you could track the money here and say, okay, well, I'm out 7 and I'm out 6. And that's another way to proceed, is just to track that money and say, okay, well, that's 13. Right. And if I buy the apple at 165 and I sell at 178, I'm just illustrating that indeed that is the break even. Right. So are you pretty good at contract specifications? Can you look at that and know that's a choice to buy Apple at 165? Yes, no. Are you there, Diego?
I'm just trying to understand. You did the T chart, debit and credit in
That's
this
exactly right.
situation. Yeah, it's the left side debit. So in
Yeah.
this
So
straddle example, it would be buy debit. So a call, right? So
we
it would
got
be
both. We
two
got both.
calls,
So we're working on
both
the call side.
calls,
Yeah, we're working on the call side right now.
calls. Okay.
Right. So we don't really care, remember, because we also have a put. And I'm going to show that to you as well. Right. So let's do the break even first, and I'll show you. So it's going to be now, it's going to be strike price minus premium, call up, put down, and that's going to equal our downside break even.
Okay.
So here we have 165. That's what we're straddling. We're straddling the strike price. So 165 minus 13 gives me my break even. Now, I'm terrible at arithmetic, so I'm not being facetious. They offer me a calculator. I'm going to say thank you very much. And so that's 152. Because we don't want to miss, it's embarrassing, but I miss questions all the time because I can't do arithmetic, which is embarrassing. Now we have this downside break even, right? That's our 2 break evens. And now let me show you that, right? If Apple's at 152, I buy Apple in the open market at 152, and then I stick it to somebody at 165. I'm the putter. And again, all I'm illustrating there is that indeed I break even, right? Because I've covered my out-of-pocket cost. Nobody does things to break even. Nobody does things to break even. People do things to make money. And that's our third test question. So we're working on our 4 things we got to do on a straddle. And the third thing we have to do is determine, where is the straddle profitable? Where is the straddle profitable? In other words, what we mean by that is, where do we need the Apple stock to be in relationship to these break evens? And so we have a great mnemonic for that as well. And that mnemonic is called SILO. SILO, not memory aid. And SILO stands for, if it's a short straddle, we want it inside these 2 numbers. And if it's a long straddle, we want it market price to be outside these 2 numbers. And so this is a long straddle. And that means we want Apple to be outside, above 1,678 or below 152. That's where we want the Apple, because we're buying the volatility. The direction is uncertain. So we're looking over here, right? So I'm just going to do this here.
This makes sense because we are talking about a debit. So debit widen. So
Well, yeah. Now remember that you're using memory aids for spreads, but I like what you're doing. You're absolutely right. When you buy a spread, you need volatility. Now the difference is, in the spread, you have to be right about directional volatility, right? So if it's a debit call spread, that visual would look exactly the same, except there'd be nothing below 165.
right.
Right. So you're absolutely on the right track. So, but here it's I think the way to think of it, you can think of a straddle as being a spread on both sides, basically. But right. And so here we're happy. We need Apple anywhere above there, we're going to be winners. Where do we not want the apple to be? Well, when we're wrong, right? Your point about the volatility, if we're wrong and it
Stable,
doesn't move,
narrow.
yeah, if it doesn't move, we're in trouble, right? Because that means we're going to lose money, right? So, if we're wrong and this thing doesn't move, we're going to be, losing some money. The worst price would be Apple doesn't move, in which case we lose, what we paid, right? So pretty easy to qualify somebody for who wants to buy an option position. I say, hey, is this Diego money you can afford to lose? For everybody, that's a different number, by the way. I had a client, lost, it was big loss. To me, it wasn't a big loss to him, but to me, it was a big loss. He lost like $100,000. And he goes, Dean, I can use it as a write-off. I go, man, I wish I lived in your world. In my world, that's a lot of money. So, I see some of these like game shows or something, and people are humiliating themselves for an amount of money that I would not do it for. I say, listen, I don't know what my number is, but that ain't it. I'm not gonna do that. Now, our last thing we got to be able to do is determine when we would use a straddle. Right. So we've done our 4 things. And our last thing we have to do is say, okay, why would somebody either buy or sell a straddle? When do you use a straddle? And you buy a straddle when you expect volatility, but direction is uncertain. Right. Now, by the way, we have both versions of this, right? So we're looking here at a long straddle. We're looking at a long straddle. But every strategy has its opposite. So if there are long straddles, there are short straddles. And the break-evens would be the same. The break-even would be the same, long or short. The difference would be, where it gets profitable, right? A person who's short the straddle, I say, do you think Apple's going to stay between 178 and 152 between now and expiration? Because if so, Diego, there is a way to profit. There's a way to profit. So we have 2 versions of the straddle. We have the version that we're looking at here. Well, come on. And it would just be the opposite, right? You'd want it to be in between these 2 numbers.
Sorry, I have a question.
Yeah.
So Dean, doesn't matter if it's basic or advanced options, strategies, and stuff. Always, only one side is gonna win.
It's a zero-sum game. That's right, Diego. For every winner, there's a loser. When that dawns on you, have half as much to lose. Diego, I've actually had conversations with people and said, listen, let's not turn this into a zero-sum game. Because if Diego, we could both win, but you're getting to a point where, one of us is going to win and one of us is going to lose. And that's not a place we want to be. In options, there, I had somebody, we were doing puts and I was saying, I'm going to stick it to this person. And she said, that's the most unchristian thing I've ever heard of. I would never stick it to someone. I said, well, I don't know what to tell you. In options, your point, Diego, this is not a win-win game. In this game, for every winner, there's going to be a loser, right? And by the way, we kind of test you on the losers because those are the people who get mad, right? So when you're studying, you want to study the negative things about investments, right? In other words, the negative thing here in terms of suitability is you can lose 13 points. And then the short straddle is really dangerous, right? Because in that short straddle, once it goes above 178, you start to hemorrhage money. And so short straddle sounds seductive, but you can lose unlimited sums of money because you have a naked call there, right?
Yeah.
So absolutely. Every option strategy is going to have its opposite. By the way, Diego, big kind of a concept as well. You're on the right track here. The safest option strategies are buying the position. The reason we say they're the safest, if you buy a call, you buy a put, you buy a spread, you buy a straddle, we know exactly how bad it's going to be.
Yeah, I try to imagine it like left side is always protection, and right side is income.
That's right. And when you sell options, the way I think of, you probably heard me in the lecture, we're more concerned with people who sell options because they're potential victims. Your point about that left side, right? On that. If you sell a call or you sell a put or you sell a straddle or you sell a spread, you're a potential victim. You're saying somebody can exercise the contract against you. Now, you still may have enough money in your pocket from the premium that it still works out, but it's still not going to be pleasurable. It's going to be painful, right? It's going to be painful. So, the pain in advance is in the long positions. We actually know what that pain is going to be. Now, in terms of your other thing you had, yeah,
sorry for
no,
interrupt. Yeah, just one more question about options in the test.
yeah.
It's a gossip. It's actually a gossip. So I heard that our spreads questions on Series 7 will be debit spreads. Do you know anything about this, or it's
I don't know. I mean, it's like, it depends who you ask. That's what I worry about urban miss. So even my good friend, do you have Brian the Test Geek, his paid supplements?
no?
I'm going to send it to you. So I have a friend named Brian, and he has a paid supplement. It's called Test Geek, and I'm going to send you a PDF, Diego. And the biggest part for us, and I'll answer your question, is he has a practice exam that I'm sending you that is very, very good. It has very strong correlation with the actual exam. So if you're testing Friday, maybe you want to do this Wednesday. What's that, tomorrow? Boy, timeline is collapsing on you pretty quickly. So you want to do that. And that score is Diego is going to be very reflective of what you're going to get. So I had a guy do it on Friday, got a 65. And I said, had that been the real test, you would have failed, but you're testing Monday and we can find some points. I was proud of him. He kept working over the weekend and he passed. So if you take this exam, so again, we want to be positive. You think it's going to damage your psyche or confidence, don't take it. But he also has some notes in there. Anyways, Brian and I were talking, and he says, it depends if you hired him to tutor you. He thinks that most of the spreads, the difference is always 10 points. And I'm like, I'm not so sure I would go that far. But all the action takes place between the strikes. I actually think the credit spreads are more important because it's a way of limiting risk. So if, I'm not on the test writing committee, I would be prepared to handle any kind of a spread. I would say that most of them, I think people stress unnecessarily about some of the exotic spreads like diagonals and horizontals. The vast majority of the spreads are going to be simple price spreads where what is difference is just the strikes. So, that's helpful because, all the action takes place between that. So that would be my answer to your question. I would be
also they said all the spreads in the exam would be all the horizontal spreads will be debit spreads in the exam. I don't know.
Well, like I say, I'm not so confident I would be there, but I think I would say, Diego, I want you to be menu driven. So I just told you, I think you should be menu driven on a straddle. Can you identify it? Can you calculate the break evens? Can you determine where it's profitable? When do you use it? Now, in terms of helping you in terms of test phraseology, I would first on the question, identify, put on my scratch, do those things into it. In a spread, there are 8 things. Can you identify the spread? Can you determine debit or credit, exercise or expire, widen or narrow, max gain, max loss, break even, bullish or bearish? Now, they're not going to ask you all 8 of those in one question, and they're not going to give you 8 spread questions. But options in general, again, my friend Brian, my brother from another mother, we disagree about this. I think you get 20 option questions plus or minus. He thinks it's more like 10. I'm like, well, that's a huge difference. Now, every draw is different too. As I told you, Diego, if you're not prepared for options, you're going to swear you had 125 options. And if, I've had people who are prepared for options and tell me they didn't see any, and I don't believe that. I just don't think it registered because, they were prepared, boom, 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 and they did their thing. Now,
I got a lot of suitability and options, really heavy on those.
Yeah, there you go. I think 20 plus.
Crazy.
I say
20 plus for sure.
I say 20
at least
plus.
20.
Yeah, I say 20 plus or minus, meaning I think it could be as high as 25 and as low as 15, but oh well. Now, we have 2 types of margin accounts. We have long accounts and we have short accounts. And the key to getting margin questions correct, particularly ones where, there's math involved, is to be able to know the classical margin equation. And what I mean by that is you got to be able to do an initial setup and then what we call a mark to market. And so we're always going to be interested in being able to do in our scratch paper, our official scratch paper, an initial setup and then a mark to market. Okay. And then we're going to be interested in doing both of those. And the key to being able to do that is to know the classical margin equation long and the classical margin equation short. So what we got to be able to do is take the long market value minus the debit register, and that equals equity. That's what we got to be able to do. And on the short account, the classical short equation is going to be credit minus short market value equals equity. And so if we can do that, if we can do the initial setup and we can do to market, we're in pretty good shape. So for example, let's say on the test, they say you buy 1,000 shares at 40 in a margin account. So you buy 1,000 shares, and then they say you make the required deposit. So that's where we're kind of getting hinted here. They're hinting to us that we need to set this thing up. And so I say, Diego, that means you're going to have $40,000 in market value. You owe the brokerage firm. In other words, my brokerage firm is going to loan you $20,000. That's called the debit register, debit balance. That's what you owe the brokerage firm. And then equity represents what you would have if you closed your accounts. Nobody's suggesting you do that, but that's what that represents. I think a good analogy is a house, right? Market value of the house minus mortgage on the house equals equity in the house. Or, car. The value of the car minus the loan equals the equity you have in that car. Now, maybe they say the stock goes to 50. And so now what we're going to do is what's called a mark to market. We're going to do a mark to market. You can't do the mark if you don't know the classical equation. So now we're going to take 50,000. That's the new market value. You still owe my brokerage firm $20,000. And woohoo, you now have $30,000 in equity. If you sold the securities, paid off the loan, that's what you'd walk with. Nobody's suggesting you do that. Now I call you and I say, Diego, for guys like you who pick stocks that go the right way, we're willing to advance you a further loan. We love lending customers money. It's one of our all-time favorite things to do. And what we can loan you is up to 50% of the market value. And so I can extend you a loan of 25,000 and you've only borrowed 20.
Right.
You need to be at risk for 25 and you're at risk for 30. You have, Diego, excess equity. We're comparing that to Reg T, which is 50%. And I say, hey, Diego, you only need to be at risk for 25 and you're at risk for 30. You have excess equity. And you say, well, Dean, do I have to do anything with that today? I say, nope, you don't have to do anything with this today if you don't want to. And let's just make a note that you have 5,000. You can have that as cash, or you can have that to buy additional securities. My favorite would be buy additional securities. As I told you, you don't have to do anything today. And so I tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had more than you needed. So the key on this is to be able to do the initial setup and the mark to market. Right? Boom. Excess equity and SMA aren't actually the same thing, but for test purposes, that wouldn't mess you up at all. Right? So that's the classical kind of short equation. Right now, we have no problem with maintenance because, that's 25% and you've got no problem there. Right? You wouldn't have a problem unless that goes down. Now, where people get hung up on the short account is not knowing the setup. So now I say you sell short 1,000 shares at 40. So now you got to be real careful. I say, Diego, you're going to get 40 grand from selling the stock you don't own. But then you have to put 20 with it. And this is where most people get hung up. You're going to have $60,000 in the credit register in cash. You say, where'd that come from? I say 40 grand from selling the stock you don't own, plus the 20 grand I made you put with it. And what you owe, the second ledger line, is still what you owe. But now you don't owe money, you owe securities presently valued at $40,000. Again, this is the initial setup short. And you have $20,000 in equity. You're right at what you need to be, which is 50%. Not testable, that's called perfectly balanced. And most people are perfectly balanced on day one, right? Because then the stock goes wherever the stock goes several days later, several weeks later. I call them time clock questions, right? And the key to the time clock question now is once we've done the initial setup, we got to do a mark. So you tell me, where's the stock at? Did it go up or did it go down? Let's pick one. It doesn't matter. Up or down? You're going to be a winner or a loser?
Up.
Okay, up. Remember, Diego means you're a loser. Because when you're short the stock, you want it to go down. And so, So let's say now the stock is at 50. I just made up 50. The test makes up the question. And now, again, as I said, the key is to be able to do the mark. So with the stock at 50, you still have $60,000 to buy back the borrowed stock if necessary. But now I'm a little concerned, my friend, because now if we went in the open market and bought back the borrowed stock, there'd only be $10,000 left over. And you say, yeah, I lost $10,000. I say, yeah, so far you've lost $10,000 because the stock has gone up instead of down. You sold it, sold it short and it went up. That's not bueno. I say, hey, listen, my friend, I got some bad news for you. You only have $10,000 in equity. And to maintain the short account, you got to have 30% of the market value. And unfortunately, 30% of 50 is $15,000. And you only have 10. So what I want from you?
Margin call. Is it 5,000?
That's right. And I want it like now. Right. So, you say, Dean, T plus 2 plus 2. I go, no. That's a margin call. This is a maintenance call. So it's due promptly. All right. Well, that was a pretty aggressive list for our hour, Diego. But like I say, I'm not, if you need some more help, you just reach out. I'm very fond of Brazil and all my Portuguese friends, and whether they're in Angola, Diego, my Angolan friends, when they visit me in San Francisco, my friends would say, your African-American friends were here. I go, they're not African-Americans, they're Africans. They're from Africa. So I always asked them, I said, hey, we could meet in Lisbon if you wanted, because, Angolans can go to, Lisbon, or they can go to wherever, Sao Paulo or wherever. Anyways, they said they like coming to San Francisco, where I spent most of my career, because they said that even in Portugal, they still get treated like they're, second-class citizens, so to speak. But you reach out and you get some more help if you need it. You don't need to book tutoring. Just let me know and I'll try and send you a Zoom invite or whatever. And if you're struggling with these hedges or whatever, are you using, you said Kaplan?
Kaplan, yes.
So just send me a QID. If you find a hedge question and you want me to, go over it with you, just send me that QID and I can pull it up and see what you're looking at. And then I'm going to send you today my friend Brian's paid supplement. I'm going to comp it to you. The biggest part of that I want you to kind of think about is that practice exam. It's a really good mark for you in terms of if you don't think it's going to break your confidence level, do it. I would embrace it, because if you got 68, I wouldn't recommend it to you if I thought it would cause you to go backwards. And I think with a 68 on the real exam and the work you're doing in terms of your 80s, I think you're going to get 70 plus, and it would be a good thing for us to know that we should feel good about your expectation for testing victory Friday if you do over 72 on that exam. So I'll get to you sometime today.
All right, sounds good.
He also has in there too, just one more thing. He has some option practice questions. And
Yes.
if you want to do those, you can do those. They're really kind of spot on as well. And you can, if you have questions on those, you can just send them to me as well. Okay.
Sounds good.
All right. I'm
Thank
with
you.
you, man. I'm with you. So I'm sending you good testing vibes. And this is Tuesday, Wednesday, Thursday. So Friday, I'll be home sending you some good vibes. If you need any more help, just like I say, I don't want you to, worry about reaching out to me if you need me.
Okay. Sounds
All
good.
right.
Perfect.
Bye-bye.
Thank you.